Hey guys, I'm Phil Town from Rule 1 Investing, and today I'm going to discuss the 3 behaviors that signal a bad investor. Hey, we're all creatures of habit. We all know that. And kind of once we get into a groove with something, we tend to kind of keep on doing the things the same old way. And that's fine if you have good habits, habits that'll help you make money. Many investors, though, have generated some really bad habits that keep them, basically becoming as wealthy as they should have become. And a lot of times, people aren't even aware of their own bad habits. So the first step is to take a really honest look at yourself. And once you become aware of what you're doing, all right, then you can change it. So the good news here is that there are easy solutions to all the sort of bad mindsets and behaviors we're about to discuss. When you put the solutions into place, you're going to be doing a world of good for your portfolio and for your future financial independence. So here are 3 bad investment habits you got to stop doing right now. All right, first, you're not thinking long-term. And man, that is the entire world out there. If you're trying to get rich quick, you've got the wrong mindset, you guys. If you're trying to make money on something right away, you've got the wrong mindset. Investing doesn't make you wealthy overnight. In fact, investing hoping you're going to get a real big hit on a stock, something that goes right up, is pretty unreliable. Successful investing is all about having a really good long-term strategy. And Rule 1 strategy, the one that's used by Warren Buffett, Charlie Munger, lots of great investors, kind of stuff we teach, is all about not holding a company for even 10 minutes unless you're ready to hold on to it for 10 years. Even better, when you buy it, we really hope it goes down. And that's, of course, the kind of thing that gets into the emotions of trading. When people see a stock that they buy go down, they freak out and bail out. When we buy a company, we really hope it goes down so we can buy more of it cheaper. That's what an important difference it is to have a long-term view. In fact, our long-term view is focused on this one really important thing, and that is when I buy this company, I have a high degree of certainty it's going to be bigger and better in 10 years than it is today. And that's the key to being very comfortable and unemotional about long-term investing. All right, the second bad investing behavior you need to break is not doing enough reading. Man alive, this is just huge. People chase after hot tips. They kind of running after stuff that their friends are talking about. It can lose you all kinds of money. And the key to not jumping in on that stuff is to read. Warren Buffett is said to read about 500 pages a day. Now, he's a reading machine and a learning machine, and we're not all going to be able to emulate that sort of behavior. But Charlie Munger once said that he doesn't know a single successful investor that doesn't read a lot. Reading is basically research without kind of knowing exactly what you're trying to figure out. So when you just read a lot, you're effectively loading your mind with a lot of information about a lot of different kinds of things. It's not important to read just about financial stuff. It's important to read about the world, important to read about things you care about, things you're passionate about. And those are the kinds of things that ultimately lead to really good investments. Even giving your money to a financial advisor, maybe not the greatest strategy. If you're okay with just a lower rate of return, that's fine. But nobody cares about your money as much as you do. Really, they don't. They really care to have your money with them. They like it in that sense. But you cannot afford to rely on other people's opinions if what you're after is really low risk, high rates of return. The solution for that kind of investing, low risk, high returns, is to take your financial future into your own hands and do your research by reading and reading and reading. And you'll discover that you're going to start seeing opportunities with companies that match up with your passions and your talent and where you're spending money. All right, so what should you look for when you're kind of digging into that reading and doing research on a specific company? Well, it's really simple. You're just searching for companies that meet these 4 tests. All right, you ready? 1, it's got to be a business you understand, right? You got to respect the company's values and know what they do. That's huge, because if you don't understand the business, the rest of this has no value whatsoever, because you won't know if you got it right. All right, number 2, it's got to have protection against competition that's intrinsic to the business. That means it's really tough to compete with this company. They've got a niche that they protect with something baked into the company, like railroad tracks are baked into a railroad company. All right, so some kind of protection. 3, it's managed with integrity and the people who are running it are talented. I really want to have managers or CEOs that I trust, right? I mean, don't you? I don't want to have them turn into mercenaries and traitors and, really damage me as an investor, because I'm in this for the long haul. And 4th, it's selling at a big discount, what we call a margin of safety, a big discount to its real value. Now, once you learn how to do that kind of research where you figure out these 4 things, it's going to be easy for you and it'll give you powerful results. This isn't rocket science, you guys. In fact, Charlie Munger once said, this is so simple and so straightforward. If they taught it in school, I don't even know what they do for the whole rest of the semester. So this is not rocket science. This is something you can do. All right, so the final bad investing habit, this one you got to fix, is not keeping up on what's going on with current events. Now, we talked about reading a lot before. Reading about current events is its own category. We do this every day. We talk a lot about waiting for a business to go on sale, right? What does that mean? Well, it means that the company you buy should be a fantastic business. That's a wonderful business. Something that you know is going to be bigger and better in 10 years. And second, you should buy it when the price is really right. A price that takes into consideration the natural ups and downs of life, right? So you start by creating a watch list of really great companies, those that meet the first 3 tests that we just discussed. All right, so it's got to have meaning to you with your values and you understand the business. It's got to have a big moat that protects it, and it's got to have really good, honest management that are talented. Now, these companies, once you get them on a list, these companies, these are businesses that are meaningful to you and are poised to do well over the next 10 years because they're really protected from competition. Now, if this isn't the right time to buy because, you know what, you figured out the value of the business and it's not on sale, then what? Well, then just be patient. In fact, Charlie and Warren have both said the most important thing you can do is wait. Just wait. That's where you really make your money, is waiting patiently for one of these companies that you've listed that you want to own to go on sale. Now, how can you tell when it's time to pull the trigger and buy it? Simple. You wait for an event that impacts the company on your list, and it's going to be something that's going to temporarily drive down the price of the company. Some kind of, let's just call it what it is, some kind of thing that creates a lot of fear that the short-term view of this company is going to be negative. For example, there were some health scares at Chipotle restaurants, right? And that was all over the news, front page news. The company's stock price went from $760 a share down to $250 a share, with nothing changed about the company at all, except some people got sick in the restaurants. And it stayed down there for 3 years. It went down in 2015, stayed down 16, 17, 18, really didn't come all the way back up until 2019. That's when it bounced back, and it bounced back right now. It's about 800 something a share. If you had invested in the company at one of the low points like I did, your money would have almost tripled by now, you guys. And so this is not rocket science. This is a wonderful business. Nothing's wrong with the long-term view of the business. Everything's the same, but the short-term looks nasty. And that's when all the big investors get out. And that's when we get an opportunity, because we're looking for an event that affects the company or the overall market, something that will scare these investors away who are running funds and are getting out because the short-term news is going to be bad. Because you do your research, these other investors who are acting out of need to exit the market, right, to protect themselves because they're professionals and they're judged every quarter on how good they're going to do compared to everybody else, but you're not. And so while these other guys have to get out, you know these companies are in really good shape for the long term. You know in 10 years, Chipotle is going to be a lot bigger than it is today. So when everybody else is selling All right, that's when you wait for the price to come down to a really good bargain basement price, and you just swoop in and pick the companies up at a bargain price. It's really easy to keep up with the news and find these events as they happen. You don't have to spend hours a day. It takes maybe 15 minutes to scan over what's going on in the Wall Street Journal, New York Times, stuff like that, just the right sections. And the trick is to make the most of your time by looking at reliable publications like those that present you with the news you need just kind of how you need it. Now, some of my favorite resources are Barron's, the Wall Street Journal, Seeking Alpha, New York Times. Those are really good. Financial Times from Europe. So you guys, if any of the bad habits we talked about here sound a little familiar, don't worry. It's actually good news because it means that you can make some simple adjustments to your investing habits. And those adjustments, if you're doing what I'm thinking you're going to do, will really pay off big time in the long run. So just think about the big picture, the long term, doing the right kind of reading, the right kind of research, spend a few minutes a day kind of keeping up with the news on the companies on your list, and you can significantly improve the performance of your portfolio. Now, I'd love to hear from you guys. Have you been guilty of any of these bad investing behaviors? Now, leave a comment below with your answer, and I'll be sure to follow up with you. Now, thanks for watching, and go play. Hey, if you enjoyed this video and you feel it was valuable in teaching you more about how to stop bad investing behaviors, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. Hey, and don't forget to click the button on the screen for a free gift. And thanks again for watching.